4 big bullish data points, 4 big bullish bearish points. It is extremely confusing. So how do you navigate through this land? Joining us now, Aegis Capital, Stanley Crouch, as well as Fusion Analytics, Josh Brown. Stanley, if you had to balance out our bull and bear points there at the top, who wins?
Well, there's elements of each that are important. Certainly, the volatility will continue. But what we see actually is strength, and that's strength in the United States. You know, my case is the debt crisis is in Europe. It could actually lead to a contagion and be very painful. But we've solved our problem going back to 2008. It's not finished. The debt crisis continues to lag on certain things. But we've really made our bed, and I think we're relatively in much better shape than a lot of countries.
Josh Brown, do you agree with that?
Kind of. I don't see strength anywhere, but what I do see are non-catastrophic data points, and that's good enough when stocks are trading at 12 times earnings. You really don't need massive strength, which you're not getting anyway. All you really need is things that are not Lehman-esque,
You're not seeing any strength at all. 70% of companies that have reported have beaten Wall Street estimates.
Oh, wow.
Guidance hasn't been that bad.
Right.
The data points have gotten better. Nobody's saying things are great. Maybe we've gone from a D+ to a C-, but things are improving, are they not?
Yeah, well, I mean, it's hard for me to get elated when companies beat earnings benchmarks that they themselves set 2 weeks earlier. I think what we really want to focus on is psychology. Going into this week, 23% of actively managed mutual funds are trailing their own benchmark by more than 5%. Think about the psychology. What that leads to is a lot of catch-up, and managers typically being a little bit more aggressive than they would had they been above the benchmark or at least comparable. So I think that will keep a bid under stocks. I'm not looking for great headlines. They're just not coming.
Hey, Stanley, this is Herb. Am I hearing you correctly to the point where you say that you're not concerned about still fallout from Europe as it may be extrapolated out in the U.S. at some point going forward?
Oh, no. I'm very concerned about that. I think we could have a contagion, as I said. It would be very, very negative. But what I'm saying is the strength in corporate performance has been very good. The earnings revisions, yes, were made before, but they still produced the results for the most part. But the forward guidance really was reasonably better than most people expected. So what we're doing is focusing on those cash flows, low leverage, going forward. That's what we want.
I guess, Josh, listen, we're all just human beings here no matter what we do for a living. I go out, meet people, talk to people. They all ask me the same thing. Things aren't that good, to your point, right? 9.1% unemployment, millions more underemployed, inflation coming up, China fears. Why in the heck did the Dow just have its best month since 1987? I can't answer it, so I got guys like you on, too.
Yeah, you got to go back to August, September to answer that question. Think about where we came from. We were teetering on the brink of recession based on almost every forecast. GDP estimates were being slashed all summer. And basically, October 4th, we came in and hit the year low, bounced off of that, and nobody was in. So that sets up an unbelievable October. Where has it gotten us? We're really back to where we started on the year. We really haven't made that much forward progress. So the question for investors is, now what? We have another 2 months, the rest of the fourth quarter, and my take is seasonality. By the way, November, December, January, that 3-month time frame is the best of the whole year, that 90-day period. You have a lot of things like that. You also have people still underinvested. So that kind of thing will lend itself, I think, to higher share prices into year-end without any great headlines on the econ front. And again, all of this is assuming that Europe doesn't completely implode, which right now it doesn't look like we're going to see that, at least in the near future.
And
so we've been buying.
And Stanley, a beautiful segue from Josh, because I was going to ask you anyway. The Bespoke Investment Group did a great work, went back 100 years. December, the best month for the stock market historically over the past century. In other words, history is on our side. Do you expect a bullish run from now until the end of the year?
Here's the problem. It all depends on interest rates, and I believe interest rates are starting to decouple from central bank action. If we look at what happened to Italy, the 10-year, the ECB had a target. It blew way through that, and now they're struggling. So interest rates are going to be set by the market, not by the actions of central banks. Watch the spreads. Watch the high-yield spreads to treasuries. Those sorts of things will give you a telling sign. But you got to buy sustainability. That's it. Sustainability. Forget speculation. calculations on outcomes and appreciation and all the growth. I said last time when I was here, the growth story is dead, and I believe that. But that doesn't mean companies that are well-positioned and prosperous can't produce returns for investors.
Stanley Crouch and Josh Brown, gentlemen, both, thank you for coming on Street Sides.
Thank you.